Hey, my name is Rajesh. I am a direct lender in Los Angeles, specializing in 2 to 8 multifamily buildings. I am also a multifamily investor. So let's take a look at this post from Reddit. Uh, Looking to buy this house. It's triplex. Asking price is $155,000. So ignoring this address and property link up there, let's see what it looks like. $155,000, Midwest, so they're probably looking at a 3% property tax rate based on purchase price. Realtor commission standard is 3%. Assuming they self-manage, it's going to be 0. Down payment, let's see, DSCR loan minimum is 20% down. Closing costs roughly 3%, and let's say interest rates about 6.625. I actually just priced out a DSCR loan recently, and at 25% down, I know I was at 6.5%. Yeah, so the strategy I'm going to suggest is a little bit different, and it needs a lot of deferred maintenance. He's guessing it's going to cost $30K to do the regrading, about $10K for the siding replacement, and old windows and replacing a section of rotten wood porch. So let's say that takes $50,000 total. So what I would suggest, rather than paying $50,000 from your pocket, is getting a fix and flip loan and then refinancing into a DSCR loan. And under those terms, maybe we're looking at a 10.25%. Well, let's see here. Last time I priced out a fix and flip loan at 20%, we were actually looking at a 9.49% interest rate. So those are the terms we will stick with. No mortgage insurance on investment properties, it's just a higher interest rate. Loan term is 30 years, interest only period will likely be 1. This is 30 years right here. And these would both be interest only. Yearly inflation, yearly appreciation, Midwest, so you're probably looking at yearly appreciation around 3 to 4%. Yearly inflation, that's historical across the U.S., not local. Rental inflation 3.18, that's pretty conservative. I've seen areas in the Midwest inflate as 3.92, but let's be conservative. And vacancy doesn't, well, if you're doing long-term rentals, your vacancy rate's closer to 8%. So let's take a look at this. It costs $155, and he's spending $50, so he's looking at $205. It's a triplex, and its monthly income's around $2,000 a month. So triplex monthly rent is $667, so that your monthly income is $2,000 a month. And this calculator right here projects what it would be over 30 years given rental inflation, property appreciation, and yearly just currency inflation. So now that we have those out of the way, let's see what that would look like. What would this property look like? Let's say it's going to be worth $202 or $205 after the rehab. Nothing special. What happened here? Something happened here. Oh, that should be, I'll fix that later. That's basically going to be 124. That's principal balance. So that is equal to property value, which is B21 minus B22. There we go. So this is equity projection over the next 30 years. That means in 30 years that property is going to be worth about $620,000 if appreciation keeps up at 3.89% a year. Rents in 30 years will be about $4,900 a month, assuming rental inflation stays that average for the next 30 years. And let's see what insurance would cost. On a triplex in the Midwest, you're looking at about $1,600 a month. Property taxes, that's about $4,650 a year. Let's see legal. Let's say what would it cost to evict somebody? So maybe $150 a month times 12, right? 150 times 12. You're looking at $1,800 a year on evictions. I think it's closer to $2,500 divided by 12, 208. Gas, assuming that all these lines are combined, as they often are on these older properties. Let's see, a lot of water damage. He's not talking about, and he goes off on problems with the siding. It just seems like repairing the siding is his biggest concern, and that's fair. That's the damage that you notice. I would look at meters, separate utility lines. Is the gas all mixed up, or does each apartment have separate meters? Is the water are the water lines separated per unit, or is it just one meter there? Same thing with the electric. I know with Midwest properties, we're probably looking at somewhere in the realm of $50 per unit per month on average. Winter months higher, and summer months lower. So let's say 151 right there. And water, probably $80 a unit per month. So that ends up being $240. Electric, maybe $100 a month per unit, so $300, and that's on the high side. Lawn and snow, depends on how you do it, whether your property management is handling it or not. Right now you have zero property management, so you're going to have to pay somebody. Let's say you pay them $150 each, depending on the size of the lawn, obviously, anywhere from $150 to $300 per month, assuming you do it twice a month. HOA and trash removal, that would be actually included in the property taxes for the trash removal. I'm guessing, depends on the city again. HOA, I'm going to guess there is no HOA. Pest control. With my properties, they cost about $360 a year, which is about $3 a month, or rather $30 a month. Advertising, if you're doing long-term tenants, your advertising costs are minimal, maybe even like $20 for the whole year. Let's just say $2 a month there. Maintenance, this is what you're withholding every month for maintenance costs. That doesn't mean you're paying somebody $184 a month to maintain your property. What that means is that you are setting that amount aside into a separate account every single year for maintenance issues. And these are going to be small maintenance issues because we got the rehab loan here to fix up the big issues. MDF, the siding, the regrading, and the old windows. I would also look at plumbing and stuff like that, just because that's where the big expenses are when you have these issues. Same thing with the roof. That's another big issue. Doesn't mean you have to replace the roof. There are cheaper ways to protect against leaks when you have an old roof, but you want to be able to set some money aside for that. I predict leaving about $2,200 aside every month just for $2,000 a month $2,200 every year roughly just for maintenance issues, and then using some sort of line of credit, unsecured credit card with 0% zero introductory interest, or getting a special financing card like at a Menards or Home Depot or Lowe's, where they have like 6, 12, 18-month financing with 0 interest. I know Amazon Prime has a 0 interest credit card. PayPal has 6 months with 0 interest. So those are the kinds of financing programs that will help you pay for, especially materials, if not labor, to do big maintenance issues. And then with maintenance issues, you want to look at companies that do 0% financing, or just do in-house financing, even if there is a financing charge. And then your $184 a month would go towards paying that off. Let's say you have, for example, a hypothetical $20,000 debt, right? So let's figure out what that monthly looks like. $20,000. And let's say they even charge 13.99%. So you're looking at $236 a month financed for a major repair like that. Now let's say you have a 0% finance card and you've got maybe 2 years of financing, 24 months, that's $833. That's still better than paying $20,000 cash, but clearly that is not going to be enough for this right here. So let's say 8.99, and you've got 7 years. 7 times 12 is 84. That's $321 a month. So roughly double that, a little more than double that. You're still going to be losing a little bit of money, but in terms of maintenance, but it really comes down to net operating income. So your annual income, your annual operating expenses are roughly $20,000 a year. You're doing $2,000 a year in terms of gross income, or $2,000 a month in terms of gross income. That's $24,000. $24,000 minus $19,000 is roughly $4,000 or $5,000. Actual numbers, you're looking at $2,947, so $3,000 a month. Now you've got your debt service. This is the monthly payments that you're making on the loan right here. So let's see what that looks like actually. Your monthly payments on the loan, and this is pre-rehab, by the way. So this is before the refinance. So you've got your rehab loan at 9.49%. Remember that. So that's why your monthly payments are $1,400 a month in that first year. And that's with property taxes and insurance included. But let's say, no, let me double check here. No, there is no property taxes and insurance included here. This is just P&I payments. $1048, $1048, $1048, $1048, $1,468. Oops. So rehab cost finance, that might be a little mistaken there. I'm not really sure why. But $1,468 a month, $1,468.50 a month is a good guess as to what you're going to be paying every month towards the mortgage. After you refinance, you're probably going to get something like 6.5. And that's if you do not buy down the interest rate yourself. And why would you? Just in a falling rate environment and you're refinancing. It's different in a purchase, but if you're refinancing, buying down the interest rate doesn't really make a whole lot of sense in every case. There are cases where it could make sense, but in this particular case it would not. So let's see what your yearly payments would be in terms of debt servicing. You're looking at the first year you're paying about $12,000. Second year and every year after that you're paying about $13,000 a year, and you are netting your net operating income after you paid all your operating expenses. It's not good. I mean, you're looking at $3,000 the first year, at the end of the first year, second year $2,700, $2,000 at the end of the fifth year, $500. You're going negative cash flow just based on inflation and everything like that, because your rents are not high enough. So we're looking at right here losing money every single year, from $9,000 your first year, $10,500 your second year, $11,000 your fifth year, 10th year you're losing $13,000, 20th year you're losing $19,000 roughly, 30th year you're losing $30,000. Over the lifetime of owning this property, you will have lost $500,000 just in cash flow, because the rents do not cover everything. So let's say we increased the rents from $667 to $900 per unit. Let's see what that looks like now. Now you are losing much less money every year. Over the lifetime of this property, you would have lost $200,000, or a little less than half of what you were losing without raising the rents. And your net income after depreciation on the building and mortgage interest write-off, you can claim losses, which is great for your taxes, but even if you sold the building after 30 years, you're walking away with a hole of $54,000, and that's all your expenses combined on this loan. So yeah, this doesn't really make sense. You would need a building that, after putting in all that money to repair it, you need it to be worth at least, let's say, $100,000 more than the $50,000 you put in plus the $155,000 you spent on it. So you need it to be $300,000 instead of $200,000. And your exit then is $224,000 after 30 years. That means you put in enough money to get a $155,000 building. You got a loan for $50,000 to do the repairs. That's $200,000. And after 30 years, you double your investment after you pay off everything. And your cash flow is still negative every year. You need this to be at least, let's try $1,200. Let's see what happens at $1,200 a month on rents. Okay, now you're positive cash flowing. You're not exactly getting rich, but you're able to sustain it now. So at $1,200 a month, you'd have to literally double your rents just to get a cash flow of $7,000 a year. In your first year, second year, you're looking at $6,000 a year. Fifth year is $6,600. And then after the fifth year, it starts going back up. And let's see this. Let's see fully amortized. What happens here? That's probably why we were seeing such weird numbers there. Yeah, now that makes sense, because now your cash flow is going up every year instead of going down. The only time it goes down again is in your 30th year, and that's probably because of property taxes. So it almost doubles from the 30th year to the 20th year. So you start off at $4,600 a year. Second year is $4,800. Fifth year it's $5,400. 10th year is $6,500. 20th year it's $96,000. So in 20 years, your property taxes have doubled, and then from the 20th year to 30th year, it's gone from $9,600 to $14,000, almost doubling. So that's why your cash flow goes down here. But let's see what your exit would be after 30 years. And according to this calculator, we are looking at a $652,000 exit. And this is why people do real estate. But when you repair this building, you not only have to do repairs cosmetically, in order to justify the $1,200 a month rent, you're going to have to do infrastructure repairs. So you're actually looking at maybe a repair cost of $75,000 just to be conservative. And now let's see what these numbers look like again. So your net operating income, you're still cash flow, you're still making money. Your net cash flow after taking out operating expenses and debt servicing, it's about half of what it was, but you're still making money. $3,700, so you're netting $300 a month. But this is an equity play, so we are looking at an exit of $538,000 after 30 years. If you were to sell this building at the end of your first year, you'd make $42,000. At the end of your second year, maybe $41,000. At the end of the 10th year, $56,000. So the play seems to be, honestly, to fix it up and then sell it after a year. Let's see what your cash flow would be at the end of the first year after finishing repairs. So the point, it may take you 6 months, it may take you a year to finish all those repairs, but as soon as you finish those repairs and you do the refi and then sell it, now that means the end of your second year owning it, but the end of the first year of the refi. After stabilization, you're looking at cash flow of $3,700 and an exit of $42,000. So you spent all this time, you basically made $21,000 a year in owning this property. Now, if you've got a full-time job and that's not a bad side hustle, if you can manage to keep it passive, but if you're dedicating your full time to doing this, there's no money here. There is no money in this building. And as an underwriter, I can show you how to get the loan approved to get the building. But as an investor, I personally would not follow this purchase. I would not do this purchase because you're buying each unit at $52,000 per unit. $52,000 per unit. Now, if you were to get the same building for, let's say, $100,000, and it costs the same amount of money to rehab, let's see what this looks like. At the end of your first year, or at the end of 2 years, the first year you spent repairing it, and the second year you spent stabilizing it and renting it out, your net income, your cash flow is roughly $8,700. So that's 9,000 divided by 12. 87.29 divided by 12. $727 a month, which is a good cushion for smaller repairs. And you're looking at a $108,000 exit, assuming the valuation comes back at $300,000. So 108,705 divided by 2, so you make $54,000 per year. Now you can spend in the Midwest. That's not bad. That's not bad. But the secret is to lowering the purchase price and raising the rents. That's what you got to do to make this deal work as an investor.